To accurately integrate these updates from the September 2026 GST amendments, you have to understand how they restructure specific transactions and tax ledgers. These new insertions are not blanket rules meant for every registered person. They are highly conditional regulations targeting precise entity sizes and distinct supply chain structures. The architecture of these amendments operates through dual mechanisms: specific liquidity constraints for high-volume entities and streamlined fast-track pathways for small businesses. Operationally, you must master a three-pillar framework. First, the input tax credit utilization cap governed by Rule 86B. Second, complex valuation constraints under Circular 251 for post-sale discounts. And third, new compliance thresholds offering fast-track registrations and filing exemptions. Memorizing these three operational pillars is mandatory for applying these technical updates correctly on your exams and in professional practice. Let's break down the first pillar by examining the strict new restrictions placed on the electronic credit ledger. Looking at the official text for Rule 86B, the financial trigger is highly specific. This rule only applies if the value of a registered person's taxable supply exceeds 50 lakh rupees in a single month. You must apply a critical caveat to that calculation. When determining if a taxpayer hits that 50 lakh trigger, exempt supplies and zero-rated supplies must be excluded from the total value. If the threshold is breached, the core restriction activates. The registered person can now only use their electronic credit ledger to discharge a maximum of 99. The fourth exception dictates entity types that are categorically exempt from this rule, including government departments, public sector undertakings, local authorities, and statutory bodies. Finally, the newly inserted Notification 20/2025 fully exempts registered persons, other than manufacturers, who are supplying notified goods subject to tax on the retail sale price. Rule 86B operates strictly as a liquidity safeguard. It forces larger taxpayers to maintain physical cash flow for GST payments, unless they belong to an exempt class or can prove a strong baseline of historical tax compliance. Moving to the second pillar, we encounter the complex valuation traps surrounding post-sale discounts issued through financial credit notes. This table, detailing Circular 251, establishes a strict baseline. Issuing a financial or commercial credit note after a supply is complete does not automatically reduce the supplier's original transaction value. Because the tax charged on the original invoice remains unchanged, the recipient is explicitly not required to reverse any of their claimed input tax credit. The actual tax treatment of the discount diverges based entirely on the conditions established before the sale. Consider a scenario where a manufacturer offers a post-sale discount, but there is no prior agreement with the end customer. Referencing the specific circular conditions, without an agreement, these independent principal-to-principal transactions merely reduce the sale price for commercial reasons. The discounts do not form part of the GST consideration for the dealer's supply to the end customer. Now, alter the scenario. Assume the manufacturer has a prior agreement with the end customer to supply goods at a specifically discounted price, using the dealer to execute the transaction. Because the agreement predates the transaction, the post-sale discount acts as a clear inducement for the dealer's supply. In this case, the discount does form part of the consideration between the manufacturer and the dealer. The final complication arises when post-sale discounts are tied to promotional activities undertaken by the dealer. Looking at the bottom section of the circular, standard post-sale discounts given by a manufacturer to a dealer to promote general sales are not treated as consideration. The dealer is simply trying to increase their own independent volume. However, contrast this with a situation where the dealer undertakes specific promotional or marketing activities on behalf of the manufacturer, operating under a separate identified agreement. This specific contracted marketing constitutes an entirely distinct supply of service provided by the dealer. Consequently, GST is payable on that specific agreed-upon consideration. Effective tax treatment under Circular 251 hinges on a rigorous audit for prior agreements and the clear identification of distinct service obligations hidden within the supply chain. The third and final pillar focuses on procedural compliance. These amendments actively reduce regulatory friction for smaller operations by establishing exact procedural cutoffs. This text, detailing the newly inserted Rule 14A, illustrates the government's approach. It provides a fast-track registration option for small taxpayers. Eligibility is tied to a strict operational metric. This fast-track option is only available if the entity's monthly output tax liability on B2B supplies does not exceed 2.5 lakh rupees. If eligible, the taxpayer circumvents normal verification timelines and electronic registration is granted within 3 working days. The rule contains a built-in withdrawal mechanism. If the tax liability ever breaches that 2.5 lakh mark, the registered person must withdraw via Form Reg 32 and migrate to the standard registration procedure. This friction reduction strategy extends to the reverse charge mechanism, specifically regarding e-commerce operators. Looking at the summary for Section 95V, the baseline rule states that GST on local delivery services supplied through an ECO is payable by the e-commerce operator themselves under reverse charge. The critical exception shifts this burden. If the actual delivery service provider is already liable to register under Section 22(1), the GST liability moves away from the ECO and reverts back to the individual service provider. The final major compliance relief targets the administrative burden of end-of-year reconciliations. This returns section highlights that starting from financial year 2024-25, registered persons with an aggregate turnover up to 2 crore rupees are officially exempted from filing the annual return. These hard limits, 2.5 lakh rupees for fast-track entry and 2 crore rupees for annual reporting exemptions, are exact regulatory cutoffs designed to keep low-risk entities out of the administrative backlog. Zooming out, you can see how these 3 pillars interlock to form the complete regulatory framework for the September updates. The government has engineered a highly precise, bifurcated regulatory approach. Under Pillar 1, high-volume entities must navigate the 99% liquidity caps of Rule 86B, forcing them to meticulously document their eligibility for its 5 historical exceptions. Under Pillar 2, complex supply chains must carefully track the existence and timing of prior agreements to avoid the valuation traps and ITC reversal triggers established in Circular 251. And under Pillar 3, practitioners must leverage exact liability thresholds, like the 2.5 lakh limit for Rule 14A, to minimize the operational friction for their smaller clients. The ability to accurately apply the law in practice hinges on the exact recall of these numerical limits and their conditional triggers. Mastering the structural logic connecting these 3 pillars provides the professional framework needed to navigate the revised GST landscape and excel on the upcoming examination.